Hello and welcome to FI Outlook 2025. For 2025, while we don't have too many calendar events, a lot really could be at play. The new Republican administration will take over. US Fed is expected to cut rates. Emerging markets should benefit if interest rates are down, but at a time when Bitcoin and dollar strength are the two talking points or have been the two talking points in the second half of 2024, what should one expect from 2025? Will money come back into India? Will this China comeback trade extend itself? Or the dominance in the financial markets will still remain with US equities? Let's take that conversation forward with Gargi Chaudhuri, Chief Investment and Portfolio Strategist Americas with Blackrock. Gargi, it's your first time on ET Now, so really excited to host you on the show. Can I start with the big picture question? What is your understanding of the world, and especially US markets, given that 2024 has been another year of outstanding returns, at least for US equity markets, and within that, US technology stocks?
Great to be here. Thank you so much for having me. And a great place to start with respect to what the global economy is doing. A couple of things that I want to point out to you, especially as we head into the end of the year, is if you just look at globally, the rate of inflation, one of the most surprising and the most wonderful things that have happened is the deceleration in inflation that has taken place across all DM and EM nations. And that, I think, has been a big driver of consumption across the world. You speak specifically around the US, and as I think about our year ahead forecast and outlook, which we're actually going to publish in the beginning of January, one of the ways in which we're thinking about the world is an outperformance of the US, or a continued outperformance, I should say, of the US with respect to where the rest of the world is. And of course, that's underpinned by some of the macro fundamentals around growth, around the labor market, around deceleration of inflation, and very importantly, around very strong consumption and therefore corporate earnings growth.
So how do you expect the coming year to be different from 2024, which is the current year? When we started the current year, the narratives were, will the US market continue to chug along? What will happen to the bond markets? When will the bond vigilantes come and they will get worried about US deficit? And there was a lot of opinion which was centered around elections. So how do you see this coming year to be different from the current year?
In many ways, actually, some very meaningful ways in which I think 2025 will be different from 2024 is, number one, we are no longer going to have conversations around, is the Fed going to start their cutting cycle? Is the ECB going to start their cutting cycle? We already have begun to see interest rates moving lower from the very restrictive territory that they were in. So that's number one and really important. With respect to the US in particular, as you correctly pointed out, 2023 as well as a part of 2024 was very much a story about just the tech dominance or tech plus dominance. What's really promising about 2025 is that we're already finding a rise of the rest as it pertains to earnings growth and as it pertains to performance, where we're seeing financials as an example, which is a sector that we certainly like in the US, actually outperforming tech based on very strong earnings growth and expectations of margin expansion continuing into 2025. So as I said, first, we have the rate cutting cycle on way already. Second, we're going to see a healthy recovery of other sectors of the US economy and the US stock market specifically, as opposed to just a tech dominance, which we think is truly important for a continued expansion of the equity markets. And then thirdly, I think there's a lot of expectation and a lot of volatility that was in the markets as we were into 2024, with so many areas of the world, about 70% of the global population going through elections. And of course, as you know, elections and uncertainty are perhaps some of the worst things for equity investors. Now that we're going into 2025, we have seen some of those election results already. Much of the world has gone through those elections, and we have that certainty of policy risk. We saw that in India, of course, we saw that in Mexico, we're seeing that in the US now. And I think having that certainty backdrop is another big driver for continued outperformance of especially the US as opposed to the rest of the world.
Now, given that there is going to be a change of regime in United States and it is going to be Donald 2.0, how do you see that impacting financial markets? Financial markets have already seen some adjustment. The dollar has moved higher. US markets on hope that the Republican administration will boost local manufacturing, they've started outperforming. So from a market standpoint, what does this change of guard mean, and what is in the price, and what could surprise us?
Sure. So, if you think about what's happened to the equity markets since November 5th, one of the things that we've noticed is continuous outperformance of US equities. But I think it's really interesting to note that that outperformance has happened across many sectors of the market. So it's obviously tech has done very well. We've also seen other sectors like financials, which is viewed as an area of earnings growth, that's done well. We've seen small caps have a real strong outperformance. And importantly, very importantly, we've seen investors deploy cash. The day after the elections was one of the strongest days of inflows. And even if we look at just this month or the month of November, we've seen very strong inflows into equity markets, US equity markets specifically. And I think much of that trade is beginning to happen. But I want to juxtapose that with this idea that globally there's about $9 trillion that are still sitting in cash. And I think with the election and other uncertainties going away, with several central banks beginning to cut rates or continuing on their rate cutting path, we think that this elevated or the reduction of the elevated uncertainty will hopefully push many investors to step out of cash into areas of both the equity as well as the bond markets. So we're beginning to see that. We've certainly seen that since November 5th. And I think there's much more of that that's going to continue because some of that cash still needs to be deployed. And as long as the consumer is feeling good, as growth remains strong, we think that's something that's going to continue to happen both in equity as well as in bond markets.
So what is your understanding of the long dollar trade going forward, because that factor really has been at play? Money has been gravitating back to US dollar or US dollar denominated assets. Do you see that this trend would extend itself? And when do you think emerging markets will make a comeback?
Yeah, so several things, as you pointed out, drive the dollar. Obviously, so far, there was that dollar rally. Some of that took place as a result of interest rates sort of moving a little bit higher. But there's also the US exceptionalism story, right? There's also the flow story, where, as I pointed out earlier, we are seeing investors file into US fixed income, given the yields that are available, the income that's available in US fixed income markets, as well as US equity markets. So all of that is actually what underpins the dollar strength. Now, to your point, as it pertains to EM, we're always a bit cautious about looking at EM as a monolith, right? So there's obviously going to be some very, very dispersed stories across EM that's going to take place throughout the course of 2025, and especially next year, as we all, as investors and consumers, grapple with the possibility, certainly not the certainty, but the possibility of higher tariffs. There will be some pockets that do better than others. So obviously, we don't know enough about this now, but again, this is why painting EM with one paintbrush is might prove to be a little bit tricky, especially as we learn more about which countries and corners of the world are getting impacted, if at all, with more tariffs than the other, what their retaliation measures are. We've often talked about sort of taking a more active approach to investing, and we think next year will play out to be another year that you want to be a lot more dynamic and sort of be very quick to change to some of these sort of policy shifts, both on a fiscal as well as on a monetary side, that are coming through.
One of the large factors, Gargi, which was at play is US productivity gain, which has been a function of AI and other new disruptive technologies. How do you see that changing going forward? And if I may also add one more point, the whole interest rate scenario, which was super low post-COVID, is now normalizing. So both these factors, in a sense, have really kickstarted the US economy. But do you think incrementally the impact of productivity gain and low interest rates now will start fading away?
Yeah, so you lay out the drivers very well in terms of one, AI as being a huge generator of capex. Obviously, the liquidity that came in the post-COVID world. But I would argue that we're just in the early innings, just in the beginnings of what AI can do for our productivity enhancement. We've just seen that follow through, like the earlier phases, the initial phases has just been in the hyperscalers. I think we're now going to, over the next few quarters, years, and perhaps even decades, going to see the adoption and actually the productivity efficiencies and efficacies of AI. So we've only seen that in the tech sector. 2025, I think, is going to be the beginning of the enhancements of AI, just sort of building into some of the other areas of the market. We saw that a little bit with sort of utilities, with the power demands of AI playing through last year. I think we're going to see much more of that, whether that comes to areas like healthcare and how much we can benefit, we all as an economy and we all as consumers of healthcare can benefit with AI giving us either faster results and as a result of that bringing down costs and making the sector more productive. Or areas like financials, for example, where obviously, as someone that's in the financials markets and certainly using AI, but to the extent that we can all be a lot more productive with the use of AI. So I think we're very much in the beginning phases of that. Then moving on to some of the other areas that you were talking about with respect to productivity. Look, as we think about what we're going to have in terms of fiscal policy for 2025, a lot remains to be seen for now, but there are some expectations of some amount of fiscal relief, especially on the tax cuts front. And again, if that is something that we contend with in 2025, we can suddenly see corporations react pretty significantly to that. So I certainly don't think that we're at the point where we're questioning where the next boost to GDP will come from. And then remember, the drivers of growth isn't just on the productivity front, but it's on the demographics front as well. And to the extent that the global economy, and certainly the US and the Indian economy.
If you like this video, then like, share and subscribe to ET Now.